Okay, time for conversation. We have with us Rishi Kohli, CIO at Jio BlackRock AMC, joining us in person, in studio this morning. Great having you here, Rishi.
Happy to be here.
Wishing you a very good morning. Let me start off by setting the context here. We have been through a year of uncertainty where Indian markets are concerned. Where do you see Indian markets at the current juncture? And how are valuations looking to you in relative terms? How is it likely to play out maybe over the next 6 months?
Sure. So Indian markets, as we know, have been subdued over the last 18 months, right? And it's largely to do with the earnings growth continuously disappointing for so many quarters. I think the previous quarter was the first time when there was a minor uptick and some hope, that that trend is turning around, and more granular data that we look at because we are more data-oriented and model-driven in terms of upgrades versus downgrades, overall target price changes, and other analyst sentiments. It marginally improved previous quarter. This quarter so far, numbers have been mixed, but largely in line, and a little bit of further growth is happening. If that continues till the next March quarter, then I think there will be positive sentiments that will come back pretty strongly. My personal expectation and view is that that will happen. But obviously that will lead to the real uptrend and smoothness in the markets, according to me, because finally markets will follow that. And of course, with recent positivity that has come out with the trade deals and other things, should also help in improving that sentiment. Once that happens, then of course you will see FPI flows and other things also playing in. So far that's obviously been missing because things have been disappointing from that front.
Rishi, the one thing that's played out in the market for all through last year and now is the sectoral churn, and that's coming at such a fast pace that it's very difficult to keep abreast. I mean, look at what's happened overnight, or rather in the last 3 days, on the news scare about Anthropic and their new AI tool and what it's done to IT all of a sudden. Where do you think sectorally are we headed in terms of where leadership and where the underperformance is going to be within the Nifty pool?
So it's interesting you're asking that. Honestly, currently we are having our NFO on a Jio BlackRock sector rotation fund, which is meant to sort of capitalize on these themes. Because, I mean, to give the backdrop, the larger picture is that whether markets are good or bad, up or down or sideways, you do have some sectors that are always outperforming, in all types of market conditions. And if one can keep rotating across those, or at least keep doing more dynamic changes in the weightages, then that really helps, outperform. So that fund is supposed to, focus on that and give a very differentiated source of alpha. Because interestingly, globally, there's a lot of research around this, that there are 3 pure sources of alpha. One is stock specific, second is sector specific, and third is what is globally called as factor or styles. In India, there's too much focus on stock specific, no talk about any of the other things. Factor style does get a little more complex. Recent few years, you do have passive and active funds in that space, but very, very limited. But sector is the big one, which is completely missing at, right now. And therefore, we are coming out with this fund so that any investor can get this differentiated source of alpha, which can obviously improve your risk-adjusted returns overall at a portfolio level and lead to very good diversification. So that's the backdrop. Within that, of course, fundamentals and macro, flows, technicals, a lot of risk parameters. So our models combine all of this, right? And obviously, we are going to start trading very soon. So I can't really comment on what immediately the model is showing. Sure. But say a month or 2 back, what it was showing was an overweight on pharma and banks and an underweight on information technology, FMCG, a little overweight on materials as well. So that was the positioning. But of course, we have a monthly rebalancing on the fund, and therefore the weightages will change dramatically every month. Having said that, of course, there's a wider range of exposures that each sector we will be taking in. So that will change dramatically every month, but obviously not like churn 100% every month. It is more like a 10 to 15% churn every month. So some of that positioning will sort of play on for the quarter, since the major changes obviously will happen once the quarterly numbers are out. But a lot of alternative data we use, for example, there the changes will happen faster, and therefore we need a shorter time period to make those changes.
How does it work out? Because you spoke about the fact that, we are in India, the focus is on stocks and not sectors. And you're looking at the sector rotation fund, which is here. And you briefly gave us an idea of where the sectors are where a few months back. Uh, when the churn happens, I mean, sectoral teams are normally long run teams, which is there. And you're talking about 10 to 15% churn, which is going to happen on a monthly basis. It's almost like a stock churn, which you're doing, right?
No, so interestingly, what we are doing in this fund is that we are looking at global GICS industry classification level 2. So as we know, level 1, we all talk about financials, autos, etc. But a simple example is financials. If you go to level 2, then banks, NBFCs, insurance are treated separately. And obviously, as we know, there are different metrics that you need to compare for each of these subsectors. So the analysis is happening at that GICS 2 level, which is currently 25 sectors. As we know, that classification, it may increase or decrease at different points in time. Now, of those 25 sectors at any point in time, on an average, we will have 17 to 18 in our portfolio. But it is more like a sector portfolio. So once I have the sector overweight, underweight, then we are largely investing in all the stocks in that sector in the ratio of the free float market cap. So the portfolio in terms of number of stocks will be very high. But that is not the right way to look at it, because you are investing in sectors, and let's say a sector has a 10% weight. The model says that you can go from 0 to 20. So that's a very wide range. And if in 17, 18 sectors, you have that drastic and overweight or underweight, then you can imagine that it is as active or more active than most other funds out there. And that is what will lead to the alpha over time. Our model has an optimizer on our Aladdin platform, which is much talked about, which takes the risk and the cost estimates and liquidity estimates also into account, along with the alpha scores. So, in India, we all talk about alpha scores and relative return expectations, basically. But I think risk and cost is super important, which nobody talks about. And because the transaction cost analysis, the slippages, impact cost, liquidity, because as we know, you're trading $1 million in a small cap versus $1 million in a large cap, you'll have a different impact on the small cap, and that'll lead into your expected returns. So that all analysis is going together into Aladdin optimizer, and then my most optimal portfolio of stocks and weightages is coming out. So the portfolio is already cost adjusted, and therefore this, whatever churn is there, firstly, it is not like, 50 or 100% per month. It is 10 to 15, which is still reasonable. And secondly, that is all accounted for in the model.
How do you, look at the entire equity markets at this point in time? Because globally, if you see the three asset classes, whether the AI-led investments in various companies or crypto, or for that matter, precious metals, we have seen a sell-off happening at this point in time. But money is not going into equities; it's going into treasuries. How do you see that flow in the context of India?
Yeah, so globally, clearly over the last year, the theme has been AI, right? And which is why you've seen markets like Korea, Taiwan, etc., really going up, and India not really performing. So currently, I think the market consensus is that India is sort of an anti-AI trade. So if once the AI things cool off, then India is going to be the beneficiary, because domestic growth-oriented, fast-growing, such a large economy, there's hardly anything else in the world. But again, as I said in the beginning, that the earnings growth needs to play out. My expectation is that it will. The rest of whatever quarterly results are there for the current quarter, and finally for the March, which is the most important, obviously being financial year end. So once that plays out, then India will start picking up for sure. And the AI trade, of course, I mean, it's been super strong over the last 12 to 15 months. At some point, it will halt, and then India will get that allocation. And FPIs, of course, I wouldn't consider the FPI outflows very seriously. Domestic flows have been strong, as we all know. That will continue to be strong. We are seeing that in our flows as well. Very strong retail flows from just digital direct distribution. We have 40% of AUM from B30 cities, but all digitally, which is speaking of how strong the SIPs and other things are. So that is expected to continue. And FPIs, honestly, used to be very important 15 years back, when the markets were less liquid, there was less breadth, depth, domestic flows were not there. In the current juncture, if you see the last 5 years, then they have become momentum players, right? Trailing 6 months returns are negative for 2 months in a row, you'll see outflows happening from them. Trailing 6 months returns are positive 2 months in a row, you will see their flows coming back. So if what we are expecting post-March quarter happens, then you'll see one or two very strong positive months, and you'll see their flows coming back as well.
You see, in this very impatient world, while you can't really predict what's going to happen in a month or so, what you can foresee is earnings. And I think as Indian investors, that's all that you can predict. Where do you see the profit pool getting collaborated, basis what we've seen in the earnings so far?
So I think banks, metals, oil and gas, some of these are looking better from an earnings perspective for sure, immediately. And even over the coming year, I think these are relatively better placed from an earnings perspective.
Where within banks?
So PSU banks and smaller private sector, I would say.
Okay, so you'd avoid the larger banks. No. Sorry,
Personally, that is more a personal view. Of course, on the fund and the model, it is more benchmark plus minus sort of ranges that we have. So the larger banks will always be there.
No, so why not the larger banks? I'm trying to get a sense.
So, the rate cut transmission has not happened, as we know. So the loan growth is happening, but deposit growth is not happening so easily. And that is obviously impacting the bigger banks a little bit more because the smaller ones and the PSUs have sort of better deposit rates. So I think, on that factor does impact. It looks very small, but that sort of becomes the most important factor at this point in time.
In terms of the overall market view, does it seem like we're close to getting a mature bull market? What stage of the bull market are we in, if you were to describe that?
So I would say 60% sort of out there.
Already
which
behind us.
because we've seen some great years. Of course, last 18 months has changed the picture, but before that, what we saw was not seen in a long time. So I think that large part has played out, which also sort of reflects into the valuations as well, which is not cheap by any means, but it's not as expensive as it looked 18 months back due to the slowdown that has happened. So there is room there, but which is why, stock selection, sector selection will be super important. I do expect that post-March, we'll have 2 very good years. Of course, geopolitics and the global developments will play a role, right? That is the wild card. And if something happens, there's a, sort of a third world war, then we can't say anything, obviously. But everything else remaining constant, I think the view is that next 2 years can be super strong. But yes, we'll have to take all these factors into account.
Would it make sense to make market cap categorizations, large cap versus mid and small caps, which have not done anything the last 1 year?
See, even then, the valuations of small caps is the most expensive, then mid, and then large. And earnings growth-wise, also for next year, expectations are largely on similar lines. I think large cap is much cleaner, much clearer. You should see 13-14%, if not higher. There are pockets which expect higher. It all depends on some key sectors, whether they perform or not. Then mid, then small. Small cap is a very wide universe and a lot of small subsectors, right? So I think there will be pockets of opportunity, which sort of shows up in one of our Flexi cap funds, where there are some segments of small cap where we are overweight, but that is more a stock-specific thing. It is not like a full sector or a full market cap being overweight. But large caps, I think, have some more room given the valuation comfort they have.
Rishi, you mentioned that FIIs have become less important in this market, but they're still very much an integral part of Indian market performance, because we've seen what's played out when FIIs don't come in and really contribute, right? You expect that to unwind, and if so, who will the biggest beneficiaries likely be, in your opinion?
Yeah, so as I was saying, post-March, numbers looking good, 1 or 2 months of good performance. April typically has a seasonality of being positive. So if that plays out, then you will start seeing from May FPI flows coming back. And of course, as we know, the weightage India has in the emerging market indices versus what emerging market and global funds, the weightage they have in India, that gap is at almost the widest in a long time. So that unraveling, and it usually flips to the other side. They'll sort of go overweight a bit on the other side. That is a large number, right? That 3-4% shift, if that happens, can lead to very large flows that come in. And that can obviously impact the markets in a big way. Typically, obviously, it depends on how and which sectors have shown those earnings at that point in time. But typically, banking definitely has some good impact of FPI flows given their interest in that segment. IT can have it if earnings pick up. It's been the worst performer, right, over the last year, even this quarter, and all this news. First tariffs last year, recently about AI and other things. So it really depends on how that plays out. If that settles down a bit, then I think that could be the other one.
Okay.
Rishi, I just want your thoughts on one sector which has been in news all of last year, defense, and now we are seeing a big correction coming through led by HAL. What's your thought on that?
So I think over excess is sort of correcting. In the long run, I would be positive. But again, as I said earlier, based on valuations and pockets within that, one will have to be very, very stock specific.
Okay, makes sense. But Rishi, great to have you in the show today.
Very happy
Thanks
to be
for your
here.
time
Thanks.
and good luck for your fun.
Thank you.
Okay, let's just revisit